Focus. Ideate. Innovate. Enable.
Hello and welcome to another episode of NSE FinViz powered by CNBC TV 18 Season 2. This week we are at the corporate office in Mumbai of one of India's oldest pharmaceutical companies, GlaxoSmithKline Pharmaceuticals. Established in the year 1924, GlaxoSmithKline Pharmaceuticals Limited is one of the oldest pharmaceuticals company in India. With the mission to improve the quality of life by enabling people to do more, feel better and live longer, GSK Pharmaceuticals believes in putting its values at the heart of every decision that it makes. With employee strength of more than 4,000 people, GSK India's product portfolio includes prescription medicines and vaccines. The company has been a market leader in most of the therapeutic categories in which it operates. Focusing on our theme for the series, NSE FinViz visited GlaxoSmithKline Pharmaceuticals Limited in Mumbai to gauge thoughts and notions of the young employees on investments and financial planning.
I have quite a lot of investments with unit-linked plans. I've got investment in SIP, which is systematic investment plans, and a couple of insurance, of course, here and there.
There's no asset strategy that I follow, but in terms of different instruments like mutual funds, life insurance, real estate, these are the different instruments, portfolios that I look into when I'm investing and have a balance of it, but nothing strategically looking into it.
I would like to know from your experts the tenure, a good tenure for an investment. Should it be a systematic investment plan, or should it be that I invest everything at one go and wait for 15-20 years for it to mature? Also, I would like to know what investment sector should I invest in. Should it be infrastructure bonds? Should it be your growth funds?
The main factor that influences my investment is my family, because I have seen how they have grown their money and I consider them to be the best source of information for me. My family and I do have some colleagues who do give me advice, but I think I need some tried and tested sources, and I'm hoping that today I'll be getting that information.
Well, it's now time to meet our experts. We have Mr. Gaurav Mashruwala, who's a financial planner, and we have Gajendra Kothari, who's the CEO at Etika Wealth Management. Gentlemen, thank you so much for being here. Gajendra, first question to you. When somebody starts investing, when they start their personal finance, what are some of the very basic pitfalls that they should be aware of?
What happens most of the times, we see advertisements and we try to go away with it. The basic rule of thumb is that first just define what are your goals, and don't just say what the print media or television media, what your friend says, Each of you are unique and each of your situations is different from others. So you have to apply what is right for you and not what is right for general, right? So don't go with the tips, first thing to avoid. And secondly, we generally fall for, borrowed advice. We have a lot of friends and family members who keep coming to us and, says, this is a good investment, why don't you do it? Wealth is never created on borrowed advice. Always remember that. You have to put in a lot of efforts, hard work, and frankly speaking, personal finance is not a rocket science topic. If you can follow just half an hour every day or a week's time, I think you're fine. And you have to just do 3, 4, 5 simple things, and you are done. You don't have to do 20 different things, and then you can become rich. So these are some of the things.
So Gaurav, he's saying, you have to do little mehnat, you have to do a little work. But why? I'm like, all right, I'll just take all my money, put it in a bank, fixed deposit. Why do I need to do all the mehnat of personal finance? The bank is there, my money is safe there.
No, so you don't have to do a lot of mehnat if you don't want to become wealthy. It's a choice is yours. If you want to become wealthy, so it's like this. And if I just want a single pot of plant in my house, it's not a lot of efforts, but if I want a garden full of wealth, then obviously I have to nurture it, and that's where the entire issue comes up. So whether it's buying fixed deposit or equity or gold or real estate, it requires a lot of efforts. Nobody ever becomes wealthy by making a lot of money. Get this thing right. You only become wealthy by keeping and managing a lot of money, and both require a separate set of skills. So to make money, you have to be good in your occupation, whatever that you're doing. To manage money requires separate set of skills. So if you're going to put all your money in fixed deposit, while you may feel it's safe, but it's losing to inflation, does that mean you go all out and start putting money into equity? No, that also has risk. So as Gajendra said, first thing is make a list of your financial goals. And that's where people have maximum problem, because that's where you have to look internally. You have to decide what are those responsibilities and dreams for which you want to save and invest money.
These are all important, you could say, pillars of personal finance. What else is there in it? What else would be an important part of personal finance planning?
Okay, so the important part of personal financial planning is keep it simple. And there's a very probable thing, keep it simple, stupid. It may look stupid, everybody may think, why aren't you into derivatives, or why haven't you bought call options and put options? May look very fancy, but stay away from them. Don't do what you don't understand. That is the biggest lesson you can have, And and as I said, by keeping simple, I'm a financial expert, and we do, but I have kept my investments and my life very simple. I've just done three things, First, I've taken care of my insurance, because we are, we have skills, right? Today we are working. What happens to us tomorrow? If you're not there, what happens to our family? So go and buy a term insurance. That's the first thing. And most of us in this crowd, you are young people right now. So that's the first thing you should do. Secondly, go and have your health insurance. And why I'm telling protection before investments? Because life, death and taxes are, certain. But the timing is not certain actually. So you should do this first. When you have done these two things, then comes the investments. And you just can divide into three buckets. Very short-term investments, where you may require in 6 months' time, 1 year time. Keep it liquid as possible. There, don't go for the returns. Okay.
So by liquid, you mean easily it can be returned,
accessible,
turned back into cash easily.
Yes.
Right.
So either you can keep in your maybe savings account or liquid funds, and then you can think about 2 to 3 year goals, wherein you can put your money in short-term debt funds or fixed deposits, depending on the tax brackets. If you come in higher tax brackets, then fixed deposit may not be the right option for you. Fixed maturity plans from mutual funds are better alternative, which are similar like fixed deposits. And then if you have anything like 5 year plus kind of goals, that money should not be in debt, or very little money should be in debt, because in the long term, inflation is the biggest monster to our savings.
Gaurav, let's come back to the basic roots. Okay, there is something called equities, which is shares, and a vehicle to invest in equities, which is mutual funds. People are very confused about that often. And the other thing is, now recently, like the Nifty's hit all times high, and everybody's like, yes boss, this is the time, abhi paisa dalo market mein. But that's not how it's supposed to be done. What's your piece of advice on this situation?
So here, first a clarification on what a mutual fund is, because I think even before we started, somebody said they want to understand mutual funds. So let me give you a completely different analogy. Say if you want to go from here to Pune, and there are a couple of options. One is we can drive on our own, or we can take a chauffeur-driven car, or we can probably go in a train or a bus. Now, if we decide to drive on our own, it's like doing directly. You decide the time when you want to start. The clutch, accelerator, brake, gears, steering wheel is in your control. You decide when you want to stop and you reach. That's like going and purchasing equity directly. You decide which stocks, you decide the portfolio, decide the allocation within those, each of the companies. You decide when you want to move out. So if you don't know driving, don't do that. Right? That's number one. Obviously, right? Why get into it? Second is what I spoke about is something like a chauffeur-driven car or a taxi where somebody else is driving. That's like portfolio management services. So while there you have the luxury of deciding when you want to start and when you want to stop or you want to take a break, but the control is not in your hand, and that's what happens in portfolio management. And the third is a public transport. So there is a predefined route, there's a train or a bus or whatever, and there's a fixed starting point, there's a fixed ending point, the stops are defined, predefined, you know what time it will start. You have to go to railway station, that's a mutual fund. Mutual funds would say clearly up front that whether it's going to invest into equity as in stock market, whether it's going to invest into gold, whether it's going to put money into debt. A debt is typically a fixed deposit or a government bond or a government security or a corporate bond. It will also tell you the proportion within which it will invest into all three. It will also tell you whether the fund will declare dividend, as in they'll pay out dividend to you, or if there is any profit, they'll put money back into it. So that's a public transport. The benefit is because there are many people traveling simultaneously, your cost is reduced. So you have to put in some efforts. Now, when it comes to equity, if you have skills and time, both. So if you have skills but no time, don't do it. If you have only time but no skills, still don't do it. If you have both, then go ahead and do it. Otherwise, get into mutual funds.
Well, on that note, it's time for a very short break, but don't go anywhere. We'll be right back after this break.